All right, let's dive right into this explainer and explore the fascinating math behind the June 2026 SpaceX IPO. We're going to unpack what is, without a doubt, the largest public offering in the history of human capital markets. For years, SpaceX was locked away behind venture funds and wealthy insiders, just the subject of endless speculation. But when it finally opened its doors to the public, the numbers it commanded were so astronomically large that they fundamentally broke traditional valuation models. The sheer scale of it caught Wall Street completely off guard. So today, we're going to demystify the single secret variable that explains this entire financial event and figure out why those crazy numbers might just actually add up.
Priced at $135 a share, the company achieved a staggering $1.77 trillion valuation, raising $85 billion in pure cash from the proceeds. To truly understand how incredibly big that is, we have to look back at history. The previous record for the biggest IPO ever was Saudi Aramco, the massive Saudi national oil company. Back in 2019, they raised about $29 billion. Well, SpaceX just came in and raised nearly 3 times that amount. It's a completely unprecedented event that has major asset managers scrambling for a piece of the pie, and it's totally reshaping how we even think about market caps.
But as you might guess, this sparked a massive debate on Wall Street. Just consider this stark contrast. While the IPO priced the company near $2 trillion, the highly respected research firm Morningstar ran a textbook discounted cash flow analysis. For those unfamiliar, that's just the standard, conservative way finance professionals value a business based on projecting exactly how much cash it's going to generate over time. Based on that hard math, they valued the company at roughly $780 billion. That's literally less than half of the IPO price. It's a massive valuation gap that has divided analysts right down the middle, prompting some serious questions about whether the market has just completely lost its mind.
Critics legitimately argue that this gap exists because the IPO price is just a massive bubble. Think about this metric for a second. 107 times annual revenue. If a normal, fast-growing, healthy tech company goes public, it might trade at, say, 10 to 15 times its sales. Paying 107 times revenue is a price that literally no current traditional spreadsheet supports. I mean, if they make $1, you're paying $107 just for the rights to it. The bear case essentially writes itself as an overhyped money grab. Yet on the other side of the fence, optimistic firms like Oppenheimer are looking at the exact same data and setting price targets even higher, projecting a $2.5 trillion valuation.
So what's going on here? Well, the justification for that massive valuation gap secretly rests entirely on one highly unsexy metric: dollars per megabit per second to orbit. It sounds incredibly nerdy, I know, but this is the master key. It simply asks, how much does it cost SpaceX to launch 1 unit of internet speed up into space where it can then be beamed back down to a paying customer? This is the core unit cost of building the internet from the sky, and understanding it unlocks exactly why some analysts are totally comfortable throwing trillions of dollars at the company.
To understand why that specific metric governs a nearly $2 trillion valuation, we really need to look at how the company actually makes its money. People usually think of SpaceX as a rocket company, right? But in reality, it's now primarily a telecom company. In the first quarter of 2026, their Starlink satellite internet service drove nearly 70% of their total revenue. The giant rockets, the massive launch pads, they essentially just exist to feed the satellite business. The core business model is actually super simple. Pack bandwidth into a rocket, launch it, and sell that bandwidth as a recurring monthly subscription to people all over the globe. This telecom reality becomes crystal clear when we compare their workhorse Falcon 9 rocket to the new, massively scaled Starship. This is exactly where physics translates directly into economics. Now, the Falcon 9 is an incredible machine that already crushed the old cost of spaceflight, carrying about 17 tons of payload into orbit. But Starship is designed to carry almost 100 tons. It's essentially a fully reusable freight elevator to space, carrying nearly 6 times the payload of a Falcon 9 for roughly the exact same launch cost. And by utilizing Starship's massive capacity, SpaceX isn't just launching more of the old satellites. They're packing in new V3 satellites with 4 times the bandwidth. When you stack those multipliers together, 4 times the bandwidth, packed onto a rocket carrying 6 times the mass, the unit cost to deploy internet speed drops from $6.55 down to roughly 30 cents. That is an absolutely violent 95% cost collapse. In a single generation of hardware, the company's biggest raw expense has basically just vanished into thin air.
This brilliantly illustrates Wright's law, which is the idea that as production scales, costs fall predictably. But what's really crucial to understand here is that historical costs collapses don't just make an existing product slightly cheaper, they completely reshape the world. Think of the shipping container back in 1956. It dropped cargo loading costs from almost $6 a ton to about 16 cents a ton. That didn't just improve shipping, it literally created modern globalization by making it trivial to build a television in Japan and sell it in California. That's exactly what a 95% cost collapse does. It makes flatly uneconomical ideas suddenly inevitable.
So, the crucial point is how this bridges that valuation gap we talked about earlier. For the bull case to get from Morningstar's textbook $780 billion all the way to the IPO's $1.77 trillion, three specific conditions must logically follow this 95% drop in deployment costs. If these three conditions are met, the astronomical math actually starts to make perfect sense. Let's walk through them one by one.
Condition 1. Starlink's unfair market advantage. Basically, this cost collapse has to make Starlink the default global internet winner against competitors. While traditional fiber optic cables win on latency, which, absolutely matters for high-frequency stock trading or hardcore gamers, they are practically impossible to run across the Pacific Ocean, active war zones, or deeply rural agricultural areas. Trenching fiber is just incredibly expensive and slow. That leaves roughly 2/3 of the Earth's surface largely unserviceable by traditional means. Starlink, armed with this 95% cost advantage and direct-to-cell technology beaming straight to your phone, is positioned as literally the only economically viable option to light up the remaining unconnected populations of the world.
Okay, condition 2. Defensible margins. Independent space research firm Quilty forecasts that Starlink must maintain these margins, and the numbers here are staggering. They're looking at a 63% adjusted EBITDA margin, essentially their core operating profit, generating a projected $20 billion in revenue in 2026, leaving $8.1 billion in free cash flow. That is a software company profit margin operating inside a heavy industrial hardware business. That $8.1 billion in pure, unencumbered cash flow is the engine. It's the absolute necessity required to fund the company's next, highly ambitious phase without constantly going to the banks to raise more debt.
Which brings us to condition 3, AI data centers in space. This is the final payoff that traditional financial models genuinely struggle to price in. Consider the AI-1 satellite, unveiled right before the June 2026 IPO. It's designed to fly the equivalent of a top-tier AI server rack directly in orbit. Now, why on earth would you put a data center in space? Well, because down here on Earth, AI growth is currently being strangled by two massive bottlenecks, grid power and water cooling. In orbit, the sun never sets, providing infinite solar power, and you can radiate waste heat directly into the freezing vacuum of space completely for free. It turns out, space is the ultimate free air conditioning unit. It elegantly bypasses the terrestrial grid entirely, solving the biggest headache in tech right now. Now, critics correctly point out that constantly launching heavy, rapidly obsolescing AI chips to orbit is economically brutal at historical prices. And they're absolutely right. At old launch costs, it's a total non-starter. But the break-even point for space compute sits somewhere between $500 and $1,000 per kilogram. Starship is targeting a launch cost of under $250 per kilogram. The exact same cost curve that makes the satellite internet business wildly profitable makes orbital AI data centers economically inevitable. Once you cross that line, a whole new industry is born.
So, the entirety of that $1.77 trillion valuation compresses into one final, highly practical test. Do you believe engineering allows Starship to get its launch costs under $250 a kilogram and keep it there? Because if it can, we aren't just looking at a cheaper internet provider. We're looking at a fundamental rewrite of global telecommunications, energy, and artificial intelligence infrastructure. The master variable is the cost curve. If that cost collapses as projected, how will it reshape the wealth and technological capabilities of the next decade? It's definitely something to think about. Thanks for joining me on this explainer, and I'll catch you on the next one.